morning, everyone. It's Friday, January the 9th, 2026, and welcome to 7investing Live. This is our live stream format that we broadcast every Monday, Wednesday, and Friday at 10 o'clock a.m. Eastern Time to showcase some of the most intriguing opportunities within the stock market. My name is Simon Erickson. I'm the founder of 7investing. My goodness, we have got a really good show for you here today. I have one of my favorite people on the entire planet joining me, Steve Symington, one of the founding members of 7investing. We have been through quite a bit over the last 15 years together. Today, Steve and I are going to be talking about AI and what is the next intriguing AI trade out there. Steve, let me first just say it is such a pleasure to have you on the show here, and good morning to you.
Yeah, thanks, friend. It's happy to be here. It's been a while.
It's been a while indeed. Steve, for those who recognize him and recognize the name, has contributed several recommendations to the 7investing scorecard. We're going to talk about Lemonade in a minute here on the program. But I think before we jump into that, I'd like to set the table on this and talk about where the AI industry is going. How this has kind of taken the investing world by storm during the last 5 years, I would say. And Heather, let's go ahead and start maybe at the top and talk about how NVIDIA has been the market darling a lot of this. It seems like you cannot talk about AI without talking about how much money the NVIDIA has made and how much the data center is spending on NVIDIA chips out there. It's almost been a hardware company that's getting all of the attention, taking all the air out of the room. And we have a graphic that shows how much the data center is spending on a variety of things. We talked about this in December. We talked about NVIDIA's chips. We talked about all those servers, all the power requirements, all the cooling, all the neat things that are going on. Yeah, and then the next step is kind of, OpenAI comes out there and says, hey, we're going to spend trillions of dollars with our partners in the data centers because we now want to use this for software for ChatGPT and other things. I'm using that just to set the table for you, Steve, because I know that you follow the AI industry much more closely than I do. But how do you interpret or evaluate what's going on in the investing world with relation to AI?
Right. The biggest thing that I look at, and I've looked at for years, and this is someone who started his career as a software engineer who was working on neural network algorithms and artificial intelligence, back in the early 2000s before it was in vogue, right? And the biggest thing for me is are the companies actually doing something tangible and generating real value with AI? And there's so many businesses that try and shoehorn it in an effort to, I don't know, bolster their valuations. What are they trying to do? It feels very much, like, there's a lot of businesses out there that they're not creating real value. And I think the businesses that actually have AI as a cornerstone of their foundations are the ones that are actually generating real value. And picks and shovels plays, companies that actually rely on this and are doing something real with it. And generating real money and cash flows and have paths toward actual profitability. It's not something where it's like, well, that so many businesses feel disingenuous when they talk about AI and its role in their business. And that's one of the key factors that I look at.
So can we double click a little more on that? Because you're right. If we're going back to the early 2000s, we're dating ourselves a little bit, but that was kind of the first wave of a lot of this, right? It was software companies, even before AI, saying, hey, we're on board with moving to the cloud. We're not doing these bulky on-premise deployments, and all of a sudden you got Salesforce or other companies. And it was kind of like a company like Adobe was a natural fit for that, right? You want to have a cloud-based software as a service, right? The way you were doing before. But then is it the same thing with AI that you can kind of see like who is doing this from being AI native, I guess we could call it, versus like having to adapt? I mean, how do you see a good company that's doing AI right versus one that just has to keep relevancy?
I think to some extent, and some people are going to hate this answer, but you can just tell. And if you've been around the block and you've watched this happen, and we were, we're old enough, we dated ourselves a little bit, that we remember. And that was exactly what popped into my head when you talk about, web companies way back in the day. And it's, you look and you can tell who's actually using it genuinely and implementing real AI solutions, and the companies that have used this throughout their entire history. And to some extent, some businesses are kind of at a disadvantage, like your big legacy monsters who are trying to use it to revamp their legacy businesses. But then in other cases, there's companies that have been founded with AI at their core, or that have, their products perfectly fit, like NVIDIA. And NVIDIA wasn't always primarily an AI play. Like it was gaming was their bread and butter, right? And it turned out that GPUs and their ability to to execute multi-threaded algorithms, and to be able to just the way that they function and process data relative to the companies that primarily focused on CPUs, your big Intels and everything. NVIDIA's chips just happened to lend themselves really, really well, and they leaned in hard and built out massive data centers, and their products were just second to none, and they've become indispensable. And that's part of the reason we've seen NVIDIA go on to 200x for a lot of people. Not a lot of people who are willing to hang on, right? But those are the biggest factors. As some companies are ready for it and they actually lean into it properly, and some don't.
Steve, it's been interesting, and you and I, like, we've been picking stocks together a long time here, and it seemed like the first wave of this AI was this controversial debate about how can you use it responsibly, right? If you remember, AI is not a new concept. It's been around since the mid 90s, actually. University of Toronto using it for ImageNet and all sorts of things like that. But it felt like this first wave, there was the technical capabilities of it, but a little bit of a hesitation of, do I really want to feed my enterprise data and unleash it in an entire business? How is this going to impact our workforce? All this stuff. I mean, where are we in AI right now? Is it still that everybody's now fully embraced this and you're starting to see companies just unleash it everywhere, or is there still kind of early innings as we kind of hesitate and get adjusted to what's going on out there?
I feel like I feel like if we're talking about a baseball game, I'd feel like this is maybe the third inning. That's what it feels like to me. We're not in the very beginnings, obviously. I've kind of watched, like, I was managing an AI portfolio service at the Motley Fool back in, it was like 2019 and 2018, something like that. And that was before like generative AI, before everything really came out. Generative AI was a huge deal to a lot of people because it was the first time it really felt like it was something they could wrap their minds around and implement without being an AI expert. And that was huge for a lot of businesses. And then the fact that they've pivoted into like robotic process automation, your UiPaths of the world, and a lot of other businesses doing RPA stuff. We finally got to a point where these are solutions that companies can roll out without having a dedicated machine learning expert on staff. And that's I think where we are, but I think we're still really early, because AI is as amazing as it seems right now. It has so far to go, and as far as like preventing AI hallucinations I like to refer to like LLMs, for example, like your chat GPTs is very confident liars, because you can feed them sort of a narrative and they'll back up whatever narrative. And then you'd be like, well, actually you're wrong. This is incorrect. And they're like, oh, you're absolutely right. And you're like, okay.
Thanks,
but
right.
right. And there's so, as amazing as it is at being conversational and generating real insights for businesses, there's a lot of room to run, and people are still kind of figuring out how to handle that. And there are teams that are dedicated at some of the biggest AI companies in the world at further improving that and removing what they call the hallucinations, the lies that AI tends to feed people. And I think there's so much room to go. And, there's ethical implications, of course, like how much do you lean on it? How much do you allow it to make critical business decisions? But there's so much nuance, so much minutia involved with actually implementing it properly, that, and maybe it'll happen faster than I think, but I think we're several years away from really broad scale AI adoption. Whether it becomes a commodity is another question. Is this, maybe that lends itself to the idea that the companies that will benefit the most maybe aren't necessarily, to a certain extent, NVIDIA obviously has, but companies that are actually, able to and positioned well to incorporate it into their businesses once it is easier to do. And I think the companies that are already doing that effectively at scale are the ones that are the most exciting to me, because they already well understand all that minutia that's required to actually make it have a real impact on their business.
So I'm glad you brought that up, Steve, because this is not the same investing in AI today as it was a couple of years ago. It was okay to invest in NVIDIA because NVIDIA was the foundation of all of this, right? You're going to sell a bunch
Right.
of those H100 chips, A100 chips, into the dirt, into the data centers, into the servers, because they were going to power all this. And everybody wanted AI, and NVIDIA is going to win no matter who was
Yep.
using it. But now that we've got that, NVIDIA's made tons of money.
Mhm.
That's one of your best performing stocks you've ever bought.
Right. It's
But
like a 250x for me, which is
yes,
great.
that's a good return when you get
And they'll
250.
continue to make lots of money, but there's a reason I've pared it back quite a bit. Like,
Yep.
I think some of the bigger returns are behind it, obviously.
But I think we want to keep riding this trend. The title of this show is the next AI trade, and I think that instead of just going with NVIDIA, which is going to be the chips that power everything, now we're looking at business specific. What company understands this, like you said.
Right.
You just know the ones that seem like you're using it correctly and responsibly, but the others that are just kind of, they have to because they don't want to fall behind.
Right.
And we've taken lots of shots on goal on AI, as we should, because the early days it's really hard to identify.
Mhm.
But I think one that you were spot on time and time and time and time again on was the insurance industry. And
Right.
you, for 7investing, recommended Lemonade 4 times. It was a
Mhm.
recommendation and then 3-time re-recommendation of yours on the scorecard, which has just completely dominated all of them. So
Right.
congratulations, first of all, just spot on the call on that. But why insurance? Why is insurance a natural fit for AI? And then we'll get into Lemonade in a minute.
It's one of those things where it's a natural fit because it's dominated by a small number of incumbent monsters who have legacy infrastructures in place that are really hard to replace. And they are loath to truly usurp their underwriting models, their everything about their businesses, their agent networks, their buildings that they have in place. It took a business, and people who know, what stock we're going to be talking about know exactly where we're going with this. But it's one of those things where it just took the right company or companies to be able to effectively implement AI, to come into it as a lean machine with AI, again, as a cornerstone of its foundations and informing almost every part of its business. The big insurance companies are really hesitant to do that, because that means just blowing up everything they've built for 150 years in some cases. And they just want to keep doing what has worked for a long time. And they're just ripe for disruption. And that's the way it's really started to play out these last few years.
Yeah, absolutely. And if you see even the founders, Daniel and Shai, that are talking about how they built Lemonade, it was from the user's perspective. They kept saying how much people hated insurance and they hated the process of how it was going. It was taking too long. They were wondering if they were getting ripped off, and it just felt like it was this kind of yucky process nobody wanted to have to deal with, but we all had to deal with every year. And then right from the start, they said, hey, we're going to take, first of all, the human element out of it. People weren't enjoying that as much as the agents were enjoying that. But then also, in terms of the claims, following up with things, they want to make sure that they were going to be there whenever people need it. It's just kind of interesting how they built it from the start, which you highlighted. But then AI itself, too, it seems like this is a natural fit that this company can learn things over time, and then from a financial perspective, really improve its results.
Right. Yeah. And they've been, they've been telling us for the past few years, Lemonade, man, it's weird that it's been around for several years now, I think. And they've been telling us, since 2023, they'd be able to use their existing cash flows, to get through without raising additional money through sustained profitability, which is super exciting back then. But I mean, Lemonade uses, it's wild just to see the extent to which they've implemented AI. I mean, we knew back in 2023 they started telling us more about how they were using it. They've got it's like a Cooper AI instance that saves them like 10,000 developer hours per year by monitoring their servers. pushing software builds into production. They've got I think whether they're still calling it the CX.ai instance tackles like a third of all customer requests, like adding spouses, moving homes. Like they don't need things like that to happen, and updating their policies accordingly. They have generated lifetime value spending predictions that are from AI that govern like 90% of their marketing spending. They employ it for like wildfire and weather analysis. They halt marketing and institute delayed start dates for affected areas in those cases. It's wild because they do a lot of these things and they aren't really loud about it. And it's not just Maya AI assistant that helps calculate underwriting and generate AI models for pricing purposes. It's every part of Lemonade's business. So they're just continuing to rapidly scale and drive operating leverage. And you could almost take an article that was written 3-4 years ago on this company and say, yep, still holds, which is my favorite kind of business, because I love it when things like that they're so consistent, and whether their combined ratios and gross profits fluctuate based on whatever disaster event happened in any recent quarter remains to be seen. But it's just a wonderful, consistent business, and I'm super happy that they've stayed that way. So I think we might have lost Simon, perhaps. He should be back.
He should be back. Oh no, yeah. It's me, the producer. He should be back. Hi, I'm going to do my best, Steve, and we're going to keep going until we get him back, because that is really interesting. Until we get him back, can you go ahead? Oh, it might be him.
So I'm here. I apologize. I think I need AI in my own video setup before my camera kicks me off. I was able to hear everything you saw, Steve, even if I lost myself out of this.
Yep.
I'm going to jump right back in if it's okay. Heather, even if you can't see me, let's put up the graphics about Lemonade, and we can start talking about those, because Steve was just talking, and apologies again for the technical difficulties, but he was having a great conversation about how the business is using AI within its entire organization for its own operating purposes. And you see not just the top line growth, but this is a business that's now churning out cash flows, Steve, and the gross profit margins are growing. And then, you see the premiums and stuff like that. We've got another graphic too. Heather, we can pull up the other one, please, which is showing the loss ratios and how that's coming down, which is exactly what you want to see for an insurance company. Steve, you recommended Lemonade basically the first time in 2020. I think you recommended it again in 2021, and then 2022, and then 2023. But how are you seeing this evolution of this business play out?
Well, this is exactly as I had hoped. And, one of the things that you'll note, like even on that last slide, you could see, adjusted free cash flow. Cash flow fluctuates on the quarter, but it's been generally positive. And it's just to watch their in-force premium growth continue to accelerate. Customer growth has skyrocketed. Like I wish, I had access to more of Lemonade's products. Like I have a life insurance policy through them. And I know there's other products that they've yet to roll out in every state. And it's wild to see like the continued geographic rollouts, but in the states that they're already in, they continue to attract customers because their platform is so
We may have also lost Steve. I'm so sorry about these technical difficulties. Please stand by. We'll have this all back on in one moment. Simon, do we have you back?
I'm here, Heather. I tell you, you can never,
you never know
what's coming, right? With live stream events, sometimes there's a blip in the matrix, and we end up with this. But I'm going to keep rolling. Did we lose Steve too, or is he back here also?
I believe we just lost Steve. We had him, and then we lost him, and now we have you. Well, he was discussing this growth rate plan chart, and so if you want to continue with that, we might want to start this growth right over, because we've been losing people.
My goodness.
Once again,
The
so
show
sorry
must
everyone
go
for the
on.
technical difficulties. We really do apologize.
I apologize, everybody. Wow, you can never over prepare for anything because there's always a curveball. But we're going to go ahead and we're going to talk. Hopefully, you can hear me. Heather, can you actually hear me on the microphone at least?
Yes, we can. We can.
Okay, great. Yeah. So, and Steve has done a fantastic job with Lemonade for the last 4 years of kind of following the story here. And if I can maybe pick up where he left off, hopefully on this, it's not just about top line growth. The insurance industry as a whole is about underwriting discipline. And if you're just anybody can go out there and write a bunch of policies and lose all their money when it blows up because there's something that happens like the California wildfires that puts you on the hook for paying all the claims. And if you didn't do a good job of responsibly collecting premiums, your business blows up and then you go belly up. And everyone has been always worried about using AI for the insurance industry in the past because they didn't feel there was sufficient underwriting discipline to go out there and do something like this. And yet these charts are exactly what you want to see with the scalability of the business and also the responsibility of how they're managing it. You can see the year-over-year growth rates of the in-force premiums are at the top. Hopefully you're able to see the graphic. Steadily rising, actually accelerating in each of the last, 1, 2, 3, 4, 5, 6, 7, 8, 9 quarters consecutively. This is the 9th one now in the most recent quarter. Eight quarters before that of in-force premium acceleration, right? They're growing the top line faster as they get larger. And because of when you do that, the business itself kind of knows what it's on the hook for paying out those claims. And the gross loss ratio, which is your claims divided by your premiums, your operating expenses truly divided by your premiums, continues to decline. The business has got its fixed costs that are spread across more and more premiums each and every quarter. And of course, when that happens, you're getting lower and lower percentage of those premiums that you're paying out for operating stuff. So that's exactly what you want to see. I mean, look at kind of the growth in in-force premiums in the period versus the operating expenses. Kind of they're steadily, not going anywhere as the business continues to scale. That's exactly what you want to see. Steve pointed out time and time again. There is one other thing that I want to talk about with Lemonade before. I think we might just wrap this up, Heather, because with technical difficulties, it's making it a little bit more challenging. Yeah. Oh, Steve, I hear you. Steve, you're back.
Difficulties. It took me about 20 seconds to get back, but goodness sakes.
You're here and I'm here, but I can't see you and I don't think anyone can see me, but I know that you're here because I heard you.
Yep.
Steve, yeah. I was just kind of picking up as best as I could to talk about how the business is scaling really well and the premiums are growing while the operating expenses are staying relatively flat year over year.
Mm-hmm. Yep.
The last thing I wanted to add to the conversation before we kind of open it up, and I know, Heather, you had a real quick question we wanted to ask to Steve as we finish this, but the business itself, this is a business that you can look at the lifetime value of a customer divided by the acquisition cost of that customer too, right? Insurance is one of those like a subscription-based software or something like that, where you say, okay, how much is it costing us to go out there in current dollars today to acquire a new customer versus how much, in current dollars is that customer bringing in lifetime value? Mm-hmm. And of course, 1.0 would be the bare minimum of a viable business that's profitable, where you're spending exactly as much to acquire a customer as you are getting out of it in current dollar terms. A really, really good business is about 2x or higher. And Lemonade has historically been between 2.5 to 3 times in terms of lifetime value divided by customer acquisition costs, again, in current value. And I compare this in a lot of ways to Viva Systems, who was right around that same ratio several years ago. And then it went on to be an 8-bagger during the next decade. That's kind of the same fundamental equation that you have here with Lemonade. So again, I sing your praises, Steve, as I hand it back to you. I mean, a business that is doing everything right operationally, and then also the top line is growing at the same time. That's a great combination and a formula for success for an investor.
Right. And I agree, obviously. But I think one other thing to note is there will be pullbacks along the way. That's how things work. I mean, if you're looking to scale into Lemonade, which is a personal holding of mine, obviously. But the way I've done it is dollar cost average, add when you can, make sure it's a reasonable percentage of your portfolio, and recognize that, we have a stock that is up significantly over the past year. And that's something that we just have to, we'll roll with the punches as it continues to be volatile as an individual stock. But, just gradually add, build a position over time and keep it commensurate to whatever allocations you've sort of set for yourself for individual stocks as a percentage of your overall portfolio. But I think, for people who do so, continue to add over time and build a position, if they don't already have one, will be well pleased several years from now. But that's the timeline that I think about these things for. So.
Yep, and we'll reserve the last couple of minutes here for questions. Heather, I'll jump to you in just a moment, but I'll ask the first one if you don't mind. Steve, to that note, I want to talk about good fundamentals versus valuation, because it's you can find a great company, and then there's always going to be people that are saying, oh, it's overpriced. This is overvalued. It's too expensive. It wasn't that long ago that actually the consensus price target on Lemonade was only about $30 a share. And, the street, there was about a 28% short interest. This was one that, people were just kind of like, yeah, great company. I love it. But man, it's way too expensive. Of course, the stock is now over $80 a share. So it proved a lot of those people wrong. How do you balance those two, Steve? I mean, do you worry about stocks like this getting too overpriced? And, people saying AI is overheated right now, or you're still just buying and holding onto this one for decades?
I tend to buy and hold, and I sell things when I need money for big things. And I don't think too hard, but I think I tend to lean toward looking at a valuation relative to a possible total addressable market, and the chances in my mind, the best educated guess I can make, that a company will capture a meaningful slice of that total addressable market. So, you look at a business like Lemonade with a roughly $6 billion market cap right now. The insurance industry is obviously a whole lot larger than that. I mean, we could talk about total addressable markets and valuation for another 30 minutes if we had it. But I tend not to be too scared by current valuations, because I've also learned over the years that great businesses tend to surprise you with their ability to grow into seemingly lofty valuations. And that's a very, if we're going to go back to our old employer, a very David Gardner thing to think about as far as rule breaker investing, right? That these businesses look overpriced perpetually. Essentially, and analysts' price targets, Wall Street price targets, tend to sort of be trailing indicators.
Yes,
they tend to I think Morgan Stanley just said, they just upgraded Lemonade from underweight to equal weight last week, I think it was, and it was like an $85 price target. It's like they've been telling people it's going to underperform this entire time, and of course, then you go miss you miss 150% pop over the past year because you're listening to people who say the stock's overvalued. But I think it's just a matter of how much they deliver relative to expectations, and companies like this that tend to outperform over long periods of time, until they prove they're not worth owning, I generally don't like to sell.
Yeah, and look at the chart here, right, Steve? I mean, this is the quintessential hype cycle. You saw Lemonade went public in July of 2020. You can kind of see that tripling of almost a triple of the stock price in less than a year. About 9 months, the stock price tripled, and then it came back down to earth. Of course, 2022 was a tough year for all investors, but you can almost see the hype very early in a company's lifestyle right out of the gate. But then, people start seeing the value. You start seeing it growing, the fundamental metrics. And it seems like Lemonade is back in the sunlight again here in 2026. Just interesting to see this story. I mean, you followed it the whole way. It seemed like it maybe have been pretty expensive out of the gate there, but then it comes crashing down. But you still had the conviction and say, no, there's a lot to like here. Stick with a good company over the long term like that.
Right. And the big thing for me is the thesis actually broken?
Right.
Sometimes the valuation can feel absolutely insane, and everything was in that 2021 spike, right? We all remember it, and the euphoria from investors. But for people who are willing to keep a super long-term perspective and continue to add to their positions over time, these are the kinds of businesses that can create generational wealth, in my opinion.
Yep. Well, we got a minute or two left. Heather, I'll hand it back over to you. And any questions you have for Steve about Lemonade or AI or the insurance industry?
Yeah, I do. We might have somewhat covered this, but talking about how Lemonade is using AI to cover a lot of the tasks that would previously have just been done by human agents, which is probably more pleasant for everyone anyways. Is that a significant cost savings? Because AI is not the cheapest, but neither is human labor, especially specialized human labor. Is that a significant cost savings, or is it pretty even?
Yeah, I think at first no, later yes. I think is maybe the measured answer to that, right? You have to invest in putting these systems into place and maintaining them and continuing to revamp your underwriting models to feed them. But over the long term, once you have these things in place and once you're good at actually implementing them at scale, it becomes a massive cost savings. So you'll see a business like Lemonade that has significantly lower overhead and eventually a similar book of business. It'll be very interesting to see what happens when, not if, in my opinion, Lemonade scales as far as in-force premium to anywhere near some of these legacy companies. Your Allstates and your other insurance companies that kind of do what they do. As they scale, I'm very curious to directly compare overhead because it looks a little inflated at first, and then over time, as they scale profitability, it looks significantly more attractive. And I think by then, people sort of lament not getting in earlier, but that's the trick, is to recognize. I think it's a stock picker when that's happening early.
That makes a lot of sense. And then, of course, the question my mother-in-law would want to ask is, can you still get a hold of a human on the phone if you want to at Lemonade?
You can.
I don't want to, but I know for some people that's very important.
Right. I've never had to at Lemonade, but I know the mechanisms are in place, and their bots are shockingly good at answering any question that anyone wants, but yes, escalating to people that they need to. For people like our parents, I think is definitely they recognize that they can't fully go AI on us, but yeah.
Yep, and I've got one more, Steve, to close this out. What's your conviction on Lemonade at $80 a share right now? Is this a screaming buy? You're pounding the table to buy more of it right now? Are you more of a conservative buy because it seems a little hot? Is this a sell for you? Where do you stand on Lemonade, the stock?
I'm more on the conservative buy aspect of things, right? We've had a heck of a run. I think there's plenty of room to continue to run. Depending on maybe what the broader market does as far as direction and growth stocks and money piling into mid and small cap companies. Depending on your definition, Lemonade might even be small cap. I think most people are going to call it mid cap, but if we're talking about maybe Interbond, it's the new small cap. But yeah, I think I still like it here, and I've even added recently small bits and as it's rallied, but that's just kind of how I function. So I'm not too worried about high valuations. Conservative buy.
Yeah, well, today is January the 9th, 2026. Going back the last 12 months, Lemonade stock is up 134% versus the S&P up 18%. So it's certainly been an outperformer for the last year. And a huge shout out to my guest today, Steve Symington, who tapped it several times as a recommendation for the 7 Investing Scorecard. Steve, this was a lot of fun, man. It was really nice to reconnect with you. Thanks for being on the 7 Investing Live program.
Yeah, thanks for having me. And sorry about technical difficulties, everybody, but it was fun.
We turned our live stream into a live audio stream. Still, the show must go on. It was a lot of fun to talk about Lemonade here on today's show. And thank you, Steve, very much for being here. We're going to keep moving forward. Thanks for everybody for tuning in for this episode. Next week, we're going to have Ari Hughes talking about institutional investing. And then the week after that, we're going to have Steve back again, also as a returning guest. And then also James Early, a former colleague of ours, to talk about dividend investing and where that fits in the climate that we're in of the investing market here today. So I appreciate everybody who attends live for these 7 Investing live stream events. It was interesting talking about Lemonade here today. We got some good stuff here on tap for January. But in the meantime, I hope that everyone has a wonderful weekend, and we'll see you again next week.